This is going to be a low volume day. You can't really put a lot of, it's not a great day to make predictions, as to what the investors are going to do, what the street is going to do, or how this might be impacting the future. But there is some news this morning. Tesla's off a little bit after early gains. It's probably due to a recent Elon Musk statement about Austin. We'll get into that in a minute. Bond yields are up today, and that's probably due to the economy continuing to rock. I mean, rock at shocking levels. Well, they're shocking unless, of course, you believe that the Trump economic concepts are smart and that we're starting to see the impact of them. But I'll get into that. And then part two this morning, we have an outstanding article from MarketWatch, well worth hearing about. So on November 25th, 2025, Mizuho securities analyst Vijay Rakesh issued a research note lowering his price target from 485 to 475. Well, I kind of remember about a month ago, he raised it from 475 to 485. And it says that he's maintaining his outperform rating. And so key reasons for the change, he said, were near-term headwinds for electric vehicle demand in 2026, primarily driven by anticipated subsidy reductions in major markets. Yeah, but if we get unsupervised, that will all go away. So I think he should watch out for that. Okay, United States, he says potential cuts to federal EV tax credits. What do you mean potential? They've happened already. I guess potential reductions in sales due to the end of the tax credits. The firm notes that phasing out these credits could erode Tesla's relative cost advantage, but yeah, over ICE vehicles, I suppose. China, possibly a 50% reductions in EV subsidies, impacting 34% of Tesla's quarter four sales volume, I guess, and into next year. Anyway, despite these risks, Mizuho remains bullish because of advancements in full self-driving, because of expansions into robotics like autonomous, and because of a strong quarter three production and sales numbers. Reuters has this morning. A top Tesla China executive said on Wednesday that the U.S. automaker values the role of China-based suppliers and does not exclude any on the basis of country of origin or geographical location. This seems to be in reaction to statements earlier this week where we saw headlines that were saying that Tesla is trying to eliminate all foreign makers from U.S. production. Now, this was Grace Tao. You know about her. She said in Chinese social media platform Weibo, this was in reaction. The article says that this is in reaction to Wall Street Journal said this month that Tesla has been requiring suppliers to exclude China-made components in the United States. Whether the United States, China, or Europe, Tesla applies the same strict and objective standards for selecting suppliers across its global production facilities, Tao said. I think this is a slightly disingenuous statement by Tao. The country of origin or geographic source of the supplier does not constitute an exclusionary criteria, added Tao, who is Tesla's vice president charged with handling government affairs and public relations with China. She did not directly speak about the Wall Street Journal article. Tesla's Shanghai factory achieved the lowest prices globally for consumers in China to buy its Model 3 and Model Y with the help of more than 400 domestic suppliers, Tao added, adding that more than 60% of them supply Tesla globally. Tesla has said it sources locally more than 95% of its components in the China-made vehicles. Okay, so my understanding from Elon Musk is you don't want to move the atoms around any more than you have to, and that's not just because of price. It's also because of what do you want to call it? Strategic thinking. You don't want to have your supply lines so far away that if there's problems like with containers or with shipping or with fights between countries, that all of a sudden you're in trouble trying to get your product. This has been I mean, as far as I know, he hasn't changed his mind. What do you think? So, of course, the commentary this morning by Elon was reported broadly that he will be increasing the supply or increasing the number of vehicles in the Austin market, probably about double from somewhere around 25 or 30 to, I guess that would make it 50 or 60 vehicles in Austin during December. And this was way less than the anticipated 500 vehicles, and without comment, without any statement of why the much lower number. Now, you may remember that I've been talking about for a long time that you have two issues. Issue number one, well, three, really. Issue number one is, do you have the regulatory approval? Issue number two, which is the biggest issue, is are you confident on the safety? Other people have mentioned another thing, which would be, how many people are in the control tower doing the remote viewing. And so there's an expense there. And then, of course, there's an expense associated with keeping safety riders in. So all those things, I would agree, those are true. So I should maybe have said five things. But number five would be making sure you have enough folks ready to ride. So one of the reasons stated this morning why the doubling is taking place now is because people are complaining that the rides are taking too long, or taking, when you put your request in the app, it takes too long to get there. Anyway, that's the story. There's a good chance that people are looking at that story and going, hey, wait, what happened to the 500 in Southern California? In Texas, and the 1,000 in Northern California. All of a sudden, you're only talking about a very minor increase. So this could, shake up some folks out there. This is Randy Kirk, by the way, and if you haven't bought the book yet, I'm going to say that you want to future-proof your life. There you go. That's the new headline. Future-proof your life. Spend $3.99. Or if you want to get the Audible, $15.99. Or maybe you want the paperback anyway, buy the book. Market Watch this morning. Here's this article. It seemed something of a wow earlier this week when Deutsche Bank rolled out its S&P 500 forecast, predicting an 8,000 finish for the index next year. Our hold my beer call of the day from JP Morgan strategist has just bettered that. A team led by Dubravko Lakos Buhas, I wonder if he ever has to spell his name for anybody, puts their base end year 2026 target for the S&P 500 at 7,500. Now, remember, we're sitting around 6,700 right now, with expectations for above trend earnings growth of 13 to 15% for at least the next 2 years. Now, I'm not at all shocked. I think that it's going to be a crazy 2 years. The backdrop for that base call, right around the median of forecast trickling in right now, right around the median, is 2 more early year Fed cuts followed by a pause. I don't think it has anything to, okay. I think we'll get the Fed cut in December. I think it's important. I think we'll get 2 Fed cuts in the early part of next year, and I think those are important. Why do I think they're important? I've said it over and over again, because it's going to help get the mortgages down. That's going to help housing. There was an article this morning that was talking about the 7 sectors of the economy that are in trouble. Well, it's not going to help 2 of those. It's not going to help federal government employees, and it's not going to help education, because education has a demographic cliff that it's going off right now, so it's going to be harder and harder. And besides, people are tending to stay away from going to university, and the universities are charging more, not less. So it's going to get crazy. So those 2 sectors, I don't expect to improve. But the other sectors, we've got auto is only doing okay. It will improve. You got housing, that will improve. You've got, commercial real estate or commercial building. That will improve because the regional banks are the ones that do that lending, and it's more based on Fed rates, short-term rates, rather than the 10-year or the 30-year. You will also get improving durable goods, which we'll see in a minute is surprisingly good right now. You get improving durable goods because those things are purchased on credit cards and or short-term loans. And you'll get improvements in transportation, because as you're moving more of these things around, then transportation will be good. All right, so here's what JP Morgan ups the ante. However, should the Fed ease policy further due to improving inflation dynamics, we see greater upside with the S&P 500 surpassing 8,000 in 2026, said the strategist. That possible higher bar for U.S. stocks is part of the J.P. Morgan forecast that could almost be described as fearless. In the opinion of 𝐒𝐚𝐲 and his colleagues, American exceptionalism isn't a question, with the U.S. expected to remain the world's growth engine next year, driven by a resilient economy and AI-driven supercycle. That supercycle has driven record capex, rapid earnings expansion, and unprecedented market concentration in AI beneficiaries and quality growth companies, those with strong profit margins, resilient cash flow growth, disciplined capital returns, and low credit risks, they note. I also think that what we're going to see is we're going to see some of the other 493 of the S&P 500 start to really see some positive momentum. One worry over that backdrop has been rising valuations for AI companies, but the strategists defend the average of 30 times forward price earnings for the 30 main AI stocks. These companies offer stronger earnings visibility, higher pricing power, lower balance leverage, and a consistent track record of returning shareholder capital relative to S&P, the other 470. CapEx spending, another focal point of investor concerns and market pullback at times, should grow by 34% next year for those AI 30. And of course, with the big, beautiful, with all the negotiations Trump has done, CapEx should go up with the big, beautiful bill, giving fast write-offs on building and on equipment. You should see CapEx go crazy next year. Fear of becoming obsolete, 𝐓𝐡𝐮𝐫𝐬𝐝𝐻, is driving companies and governments to invest in technology, which is helping the AI sector momentum to spread. Did you see what the president announced yesterday? It was completely buried. Go ahead, try to find it. The president announced yesterday that he's setting up a new Manhattan-style project for the fastest complete, what would you call it? Going through the U.S. government and completely overhauling its computer systems in lickety-split time, not 30 years, not 15 years like Social Security, but rather like overnight. And of course, the dojo guys are going to be a part of that deal. So there's an example of the government using the new technology, but that was buried. Nobody's talking about that. Why isn't that a big story? So they remain overweight on tech, media, telecom, utilities, defense. They expect banks and pharma to further outperform, but they're neutral on the broader financials and healthcare. 𝐒𝐚𝐲 and his team are also looking for rising shareholder payouts next year and easier fiscal policy through the One Big Beautiful Bill Act to draw investors. They added that earnings tied to deregulation and broadening AI-related productivity gains remain underappreciated by investors. Not this one. What have I been talking about for 6 months? They just don't listen to me. Deregulation, big, beautiful bill, Trump's negotiations overseas, tariffs, forcing the onshoring, getting rid of the illegal immigrants, reducing crime in the cities. All of these things are what you're going to be looking at that's going to improve the economy next year. There's one drawback that all of this AI-fueled growth, which is unfolding within a K-shaped polarizing economy. Winner take all markets, says the team. In such environments, broad sentiment measures are likely to remain prone to sharp swings, as we've seen this year and recently. Okay, but the K-shaped economy thing should go away next year. I mean, not go away, but it should improve dramatically. We're seeing that the average worker now, their wages are going up much faster than inflation. As inflation drops and their wages go up, that should begin to have these people go, wait a minute, this seems like it's working. The setup for next year doesn't look much different. In their opinion, the new extremes in crowding and record concentration in stocks, that's going to continue. Yes, so people that own stocks and people that own homes are going to continue to outperform those who don't. It's not new. That's not a new thing. Beyond the dominant AI theme, global strategic resource stocks such as rare earths and uranium should see continued momentum, given expectations for ongoing U.S.-China competition, U.S. supply chain diversification, and AI energy needs. All true, all 100% right. I agree 100%. Deregulation should drive renewed momentum for financials, housing supply chain, energy, with regulatory rollbacks boosting growth and deficit reduction. Tariff and trade-sensitive stocks could also present some tactical opportunities, they say. All right, so I thought that was amazing. This is from Fortune magazine. I think it's time for the Fed to just move back into the background like it used to do, calm things down, and work for the American people to set monetary policy on a good path. This is what Scott Bessent told CNBC. This isn't a sport, it's people's lives. The Federal Marketing Committee, the FOMC itself would bristle at the implication that it has become gamified. In exclusive interviews with Fortune, regional bank presidents made it clear that their focus is on serving the American populace. As Boston Fed President Susan Collins told Fortune a year ago, any given FOMC decision impacts individuals and their families and the communities they live in. It impacts micro firms and individual entrepreneurs all the way up to our global multinational corporations. In order to have, and she quotes, in order to have an environment that sustains rising living standards for our citizens, sustains a low, stable inflation, and an environment with maximum employment, that really matters to us. That is what the FOMC is charged by. That's our job, she says. Bessent also claimed some regional Fed presidents weren't living according to the design of the Fed. These regional presidents were supposed to be people from the district, and it was supposed to be to break the New York hold on our reserve banks. 3 or 4 presidents, he suggested, don't live in their districts, and they go out into the country and then come back on weekends. He wants the Fed out of politics. Fed presidents previously told Fortune they welcome public accountability and feedback, but are legally mandated to steer clear of the quagmire of politics. Chairman Jerome Powell has repeatedly shared this message. He says, no, this is not political. We don't make it based on pressure from politics. Back in August, Powell said in his speech, we're a non-political agency. We don't want to be involved in politics in any way. He added, Congress has, we believe, ordered us to conduct our business in a non-political way at all times, not just some of the time. We never, ever, 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 ever use our tools to support or oppose a political party, a politician, or any political outcome. No, the 50% basis cut just before Joe Biden was trying to win the second term, that would be political at all. Even when Trump and the Fed chairman met, the message was reiterated. Chair Powell did not discuss his expectations for monetary policy, except to stress the path that the policy will depend entirely on incoming economic information and what that means for the outlook. Powell won't have to field the questions for much longer. He'll be out on his ear. His term will end. On this, Bessent also had an update. The nomination for the chairman could come before Christmas. All right, now what about that economic news that was surprisingly good this morning? Well, in the week ending November 22nd, the advance figure for seasonally adjusted initial claims was only 216,000, a decrease of 6,000 from the previous week's level. And that was well under, I think 233,000 was what the street expected. The previous week's level was revised up by 2,000 to 220,000. I'm sorry, from 220 to 222. And the 4-week moving average was 223, a decrease of 1,000 from last week's. The advance seasonally adjusted insured unemployment rate was 1.3%. If you watch my show every Thursday, that 1.3% should stick in your mind by now. I can't remember it when it was any different. 1.3, 1.3, I mean, every single week. The total number of continuous weeks claimed for benefits in all programs was 1,765,777. That was a decrease of 20,907 from the previous week. That would suggest what? That people are not having trouble finding a new job. I was nervous when I read this, that this could cause the betting markets to start to lower the possibility of the Fed lowering the interest rates by 0.25. But So far, that hasn't happened. New orders. This is another story. New orders for manufactured durable goods. You know how much I talk about this. Up. 2 consecutive months, increased 1.5 billion or 0.5%, according to the U.S. Census Bureau. This followed a 3% August increase. Excluding transportation, new orders increased 0.6%. Excluding defense, new orders only increased 0.1%. It was transportation equipment, also up 2 consecutive months. It led the increase, was up by 0.4%. So durable goods starting to show some life, primarily in transportation, though not in refrigerators. We're waiting for the beginning of when it is refrigerators. Okay, the GDP now finally for Q4 is starting to show. It's at 2.8%. You know that Bessent has said that the government shutdown cost us 1.5%. Therefore, we should be at 4.3%. The GDP now estimate for the third quarter has changed a little bit, back down to 4%, which is super strong. And by the way, even if we end up the fourth quarter at 2.8, that would be outstanding. It would be above trend. Trueflation this morning, down again, 2.37. That's the overnight. The goods number down a lot to 2.28. The core down to 2.19. Services, 2.45, about what it was, maybe even a tad up from yesterday. And PCE, 2.31. Those are really, really good numbers. And speaking of the details, you're going to see, I don't know, 5 million headlines today saying that turkey prices and the turkey dinner is up compared to last year. I'm not going to go into the details. If you want to see the details, go on my X account, which you should be following anyway. If you're not following my X account, you should be. On my X account this morning, I do the full Grok result. And I said, hey, Grok, go out and find me all the data you can and get it from unbiased sources on both sides. Grok came back and said, turkey dinner down, 5%. Turkeys themselves down, 5%. There you go. Details. The left and the left press is not interested in truth. They're interested in a political agenda. Tesla this morning has now rebounded. It was starting to rebound a little earlier. We're back above into the green, $420.08. That's up 0.16. We were as high as 422 or so this morning, and overnight as high as 425. We'll see how all this pans out. Again, not a lot of activity today. It's going to be one of those days. Dow Jones up 0.51, NASDAQ up 0.49, S&P up 0.50. Boy, that's pretty consistent among those three. You've got the Magnificent Seven all up. Well, no, you've got Google and Meta both down, but everything else is up. Even NVIDIA is back above 180. That's quite strong compared to where it was at 170. Boy, would that have been a buy on Monday afternoon, 171 or something? Holy mackerel. All right. Then we got the VIX has come way back down at 18%, at 18 now. And the Cathie Woods are mixed this morning. Yeah, so that's mixed is definitely what they are. All right, let's go ahead and look at bonds. The bonds this morning, oh, they're coming back down. They were up higher. So we're now looking at 4.02. That is up 1.9 basis points. So maybe the bond market is deciding that the Fed cut is still in. They're not nervous about those two outstanding reports this morning. We've got oil this morning up 9 cents. We need to go up a lot more, but $58 right now. Natural gas back up 2.79, and they must have ended up really way up yesterday, 4.6. I have not $4.60. I have not had a chance to look at what's going on with gas prices. I got to do that later today. We've got gold up 4,153. It's about where it's been this week. Silver, though, another 1.74. We're now at 51.86. Copper up 1.57, $5.08. We've got the dollar down just a tad. We've got Bitcoin down just a tad, 87, 161. And there you go. That is all the numbers. So later today, I'm not 100% sure. I don't know what's going to. I'd love it to be Jeff Lutz. It might be Bradford Ferguson. It will not be Brian Wong because he's traveling. Cern will be around. I'll be plugging Cern in at some point. I'm not sure exactly where, but he'll have at least one show over the next couple of days. So yeah, I don't know. But last night, the card is right here. Oh my goodness. Every week it just gets better with Nicholas Gibbs. Last night's, I know it's an hour and 15, but he doesn't talk that fast. You could probably put it on 1.5. And when he talks, I hardly say anything. So you can put it on 1.5, 1.75 maybe. Anyway, or listen to the whole thing for an hour and 15. You really, really, really want to listen to that. And then when you're done, you'll know that he thinks you should buy the book too. He's a strong advocate for the book. There's nothing else on the market like it. Yeah, there's a lot of books out there on AI, but there's nothing like this book. This book goes into the full stack. It talks about every element of the stack. Then it talks about you. It talks about your life, whether you're an employee, an employer, whether you're a parent or a grandparent, whether you are interested in how the living standards will be in the future, whether you're interested in the stock market, whether you're interested in finance. It covers it all, and nobody else is doing it. I promise you, you know who the writers are. You listen to us all the time. These are solid citizens in their areas of expertise. Highly recommend you get the book and then buy one for your kids and your grandkids. Buy one for your friends, buy one for your customers. This is a serious, serious book about an extremely serious subject. Having said all that, should we see what happened to to Tesla real quick just before we go? Just for fun, see if it's still going up or whether it's turned down again. It's still going up. We're now almost at 421. Go Tesla. It's been great talking to you.